Coming up, Australian wine players react to developments in China. The Australian share market hits a one-year low and a warning on oil prices reaching 100 US. That's next. Your daily 10-minute business and finance news wrap for this Monday, the 23rd of October, 2023. Later on Market Day, we'll speak with Kyle Rodda from capital.com. But first, Australia's wine industry has called China's decision to review import duties of up to 220% on Australian wine a really significant and positive step. Industry group Australian Grape Wine says China was a $1.2 billion market for Australia prior to the import duties coming into effect. And today, those exports are valued at $8 million. And while it's not expected to get to that level in the short term, the body is hopeful of a positive outcome following China's 5-month review into the issue as dialogue between both nations continues. So for more, I spoke with Australian Grape Wine CEO Lee McLean. Lee, so China agreeing to review its wine import duties on Australian wine. How much of a big deal is this to the industry?
It's a really significant and positive step, Ricardo. This is something we've been waiting for some time now. We saw the approach that had been taken with the barley industry a few months ago now, and that was a really positive step that led to the resolution of that import duty issue. And we're certainly hopeful that we can run through this process over the next few months and achieve a similar good result.
Yeah, as you mentioned, it'll take a few months. I think that the Chinese authorities are reviewing it over 5 months. So what happens in that time?
Well, there's a few things that need to happen. I understand the Chinese and Australian governments will continue to talk to each other. Dialogue's been a really important part in getting to this point, and it's going to continue to be an important part of the process. From our perspective and our industry's perspective, my organisation, Australian Grape Wine, will be feeding some information into that process. We'll be providing any information that's required to both the Australian and Chinese governments to support that analysis of those import duties, to look at things like how the market is positioned in China for Australian wine, what's happening in the Australian supply base, etc. And hopefully that can lead us to a positive resolution.
Are Australian wine exporters ready? We heard, for example, from Treasury Wines today, basically saying they're ready to take advantage of it.
Yeah, look, I think many winemakers will be ready, although it will take some time to get it sorted out. So particularly for those exporters who are exporting premium wines, high value wines, for many of those businesses, they will have found markets elsewhere around the world in some way or another. So it will take some time to get the sourcing right, get the supply chains right, and indeed re-establish those relationships with customers as well in China. But what I do know is, and I was in China a couple of weeks ago talking to the Chinese wine industry, we know there is still a strong sort of affinity for Australian wines, particularly those red wines that Chinese consumers enjoyed. And hopefully we can see a return to a reasonable level of trade in the short term.
That's a good point that you said about Australian exporters finding different markets in the meantime. And we've often been hearing stories of how businesses need to diversify and find different markets, right? So just how important a market is China for Australian wine exporters then?
Yeah, so in terms of market diversification effort, we've been working really hard on that over a couple of years now, but it has been difficult. So there's certain businesses who perhaps have a very high value product or a luxury wine offering. They have been more successful than some of the other businesses around the country in terms of being able to find new markets. They have a much scarcer, high-value product to work with, whereas others have not been able to diversify quite so easily. So this potential reopening of China, and we've got to go through this process before we see an outcome, but this potential reopening of China will present opportunities for businesses if they're looking to get back into the market. To put it into perspective, I mean, China was a $1.2 billion market for Australia prior to these import duties coming into effect. And today, those exports are valued at about $8 million. So that's a 98 or 99% reduction in the export value. So it is a significant market. We're probably not going to get back to a $1.2 billion figure in the short to medium term. The market's changed in China a little bit but it's still going to be a very significant opportunity for us if we can get to that point.
Is there a real risk that this review could fall over?
Look, I think there is always a risk of that happening, although having said that, we are optimistic, and we've been optimistic throughout the entire process to date, through the World Trade Organization process as well. We believe that we had a very strong case as an Australian industry. I think the key thing for us is that we need to be very collaborative, very engaged with the process. We'll provide any assistance that we can to support that outcome. And we know that the team at the Department of Foreign Affairs and Trade, in particular, has been doing an enormous amount of work in trying to drive the right outcome for our industry as well.
And finally, what do you think this will mean for China-Australia trade more broadly?
Well, look, I think it's another positive sign. We've seen a really strong uptick in the political engagement between our two countries over the last 12 months or so, which has been great. That's flowed down to the officials level. And as I mentioned earlier, the industry is starting to re-engage with customers and at the industry to industry level as well. So I think it's really good from a wine perspective. Hopefully it means good things for other commodities that have been impacted by similar trade impediments over recent years. And that's going to have only positive flow-on effects for regional communities right across Australia. And ultimately, that's a really important thing.
Lee McLean there from Australian Grape and Wine.
Now, Market Day on the SBS On the Money podcast.
The Australian share market fell today. The S&P ASX 200 down 0.8% to a one-year low. For more, I spoke with Kyle Rodda, a market analyst at capital.com.
Well, I think it's the shock of what's happening in the Middle East and the uncertainties that sort of exist around, well, what's going to happen effectively if and when we do see a ground incursion by Israel into the Gaza Strip. There's also the factor of higher global interest rates, but of course, it's been a very, very big story for a while. But over the course of last week, we did see basically the entire US Treasury yield curve above 5%, which of course is a really, really poor environment for equities to be in. So, I mean, I think in the short term, the volatility is certainly being driven by this geopolitical risk, but the macro backdrop isn't favorable either with rates where they are.
So, I mean, you mentioned a couple there. Does one of those issues impact sentiment more than others at the moment?
Yeah, you could probably even put it into two baskets, something that reflects sentiment and then one that reflects fundamentals. And I think the fundamental drivers is obviously what we talk about when it comes to yields, because it's the combination of, Treasury issuance in the United States, stronger than expected growth, quantitative tightening, all those macroeconomic factors that, we're kind of aware of and have been seeing sort of play out for a little while. But when we do talk about sentiment, well, sentiment is basically a function of uncertainty, and the uncertainty does sit around what could happen in the Middle East right now. And I mean, the chain of events that would be, most terrible of all, if I can call it that, is we do see a ground incursion by Israel into the Gaza Strip. We do see an escalating war throughout the region. We see a major hit to supply chains, growth, and energy markets, all of those things that could conceivably occur, but we just don't know yet. So when it comes to this sell-off, it has been very sentiment-driven. And again, that sort of sentiment story is very much around those geopolitical risks.
A lot of talk also about oil approaching $100 per barrel in coming weeks. What's your take and what are the implications?
Well, obviously, the implications are profound because there's another supply shock for energy markets. And when it's a supply shock driving energy markets, it's both a driver of inflation, but also slower growth. So there's that kind of macroeconomic element to things, which could also, in principle, be driving what we're seeing in the bond market too. But there's also the second and third order effects that we have to worry about when it comes to this conflict in the Middle East. And that is, if we do see escalating tensions, there's this unanswered question about what the global community's response will be to Iran, what Iran's response will be in terms of trying to support effectively one of its agents in Hamas, and whether that will mean tighter sanctions on Iran and maybe even destruction if we do see broader war throughout the region to some key energy infrastructure. So if we see those things happen to occur, that could be a really significant driver to push oil towards $100, although perhaps we have seen over the last few days too the Saudis suggesting they will step in to stabilize markets. But again, we're talking about a series of unknowns here, and we have seen implied volatility in the oil market at sort of 2 or 3 month highs over the last few days.
Losses, where are they coming from today?
Very, very broad base, but it would seem that if you could infer anything from the price action, miners and energy stocks, which again sort of speaks to the fact that maybe entering the narrative now is this global growth story, not just what could happen to gold miners, maybe a few pockets of the energy market, and just a broader hit to sentiment. Maybe this could be a fairly significant growth stock. So we have seen those growth-sensitive cyclical names really underperform.
So we saw some potential progress in Australia's trade situation with China over the weekend, with wine tariffs being reviewed there. What are the implications for investors?
Well, I think this extends a story that has evolved reasonably positively over the last 12 months. And, it's probably a function of a changing rhetoric in global politics, especially when there was a change in the White House a couple of years ago, and there's less bellicosity when it came to sort of talking about trade and the political economy around that. But also we have seen a bit of a pivot in terms of the current government in the way that it likes to approach China in its relations, especially as it applies to trade and other things as well. So we've seen the removal of sanctions on coal, other agricultural products. Now it looks like wine obviously is going to be something that's going to see some of those trade barriers removed. Not a big move for, say, Treasury wine estates off the back of this. It was 1% higher, albeit on a really negative day. But it does suggest that some of those tensions that built up for a few years there between China and Australia, amidst that sort of broader environment when, trade wars were a big theme, are starting to thaw a little bit. And again, that's good for the Australian business community. Finally,
where do you see the opportunities for investors at the moment?
Well, this one's an interesting one because I think it's a great opportunity to step back to ask what your goals are. And, there's not necessarily the answer has to be in equities or getting allocation to equities. That the big part of this story is that, yields in relatively safe assets, maybe cash, maybe slightly up the risk curve, but still relatively safe, are delivering you an income of 3, 4, 5+%. So if you're an income investor, maybe you don't have to worry too much about being in equities right now because you can get that income elsewhere. Otherwise, if you do have sort of a slightly higher risk appetite and there's those sort of growth names that you are looking for that are getting beaten up because of nothing to do necessarily with kind of fundamentals, but because of sentiment, maybe changes to risk-free rates, so interest rates, it's a time to sort of, maybe create a little bit of a shopping list and a sort of list of names of companies that you think are at, fairer value, or where fair value might be for those companies to pick them up eventually. But it's, of course, always dependent on your individual circumstances. Income investors should be pretty happy with cash at 5%. But again, now with all this kind of volatility in the market, it's never a bad time to create a bit of a shopping list and see if you can pick something up on the cheap.
Kyle Rodda there from capital.com. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any